Welcome to the podcast about venture capital, where investors and founders alike can learn how VCs make decisions and reach conviction. Your host is Nick Moran, and this is The Full Ratchet.
Welcome back to TFR for another edition of Investor Stories. On this segment, the experts talk about a startup that failed and the causes of that failure. Here's the segment called Postmortems.
On today's special segment, we have Nico Bonatzos of General Catalyst. Nico, can you tell us a story about a portfolio company that failed and why it failed?
I mean, Go Butler is a good example of a company. I don't think that category, frankly, worked out. Go Butler was in the category of companies where you could text a number, whatever you had in mind, they could make it happen for you. So like, I want to send flowers to my significant other. They could do it. Please buy me tickets when the world, used to travel to New York and book me a hotel room. And they would do it. And it's one of these, so obvious and so great ideas till you understand that actually to fulfill any of these orders, to break down the task into many subtasks and figure out how to do things automatically with APIs, it's a really, really, really hard thing to do. So you end up relying on humans on the other side. So you're just a tech-enabled company and you become a very heavy, operationally intensive company. So if you don't have an unbelievable engineering team, it's really, really, really hard to make the economics work. So my lesson learned was tech-enabled companies are really hard to make work. So I tend now to avoid them.
On this special segment, we have Melody Ko of NextView Ventures. Melody, can you tell us a story about an investment that failed and why it failed?
Yeah, this is an investment that I worked on since I joined. They're in the real estate technology space. Without going into too much details, I think we never really figured out the go-to-market. And we saw some very early traction when we invested, but it became more challenging to scale. So I think that was the key challenge. And then the other components are minor, but also significant. One is the broader real estate market taking a turn. This company decided to pursue a M&A process before COVID. But, 2019 was not a great real estate year from a residential perspective. Their business model hinges on a lot on the real estate selling activities. So if the overall market is down, it's very tough for them to have enough levers to change that. On top of that, the founder also had to deal with some family situation that ended up being distracting. So, I think at the end of the day, the team just didn't feel like they had a conviction to continue.
It happens. On today's special segment, we have Rami Adib of 1984. Rami, can you tell us a story about a portfolio company that failed and why it failed?
Yeah, so none of our companies in this fund has failed yet, where I'm sure there's going to be some. But I want to talk about actually a personal story. I don't like to talk about other entrepreneurs having failed. So maybe I can talk about my own story, if that's all right. I started Snippet in 2011, and we had this very simple vision to help consumers share articles online and have conversations around their interests. So today with Facebook and Twitter, obviously with Facebook, people are sharing articles all the time. But back then in 2011, people weren't sharing articles on Facebook. So it was a very novel idea that we would have conversations around content. What was interesting is we were sort of head to head against Pinterest, but Pinterest was all about pictures. We were all about articles. And I loved the focus on articles. But it became obvious about a year in that consumers were way more interested in sharing nail art than they were interested in sharing articles about socioeconomic things. And we had a lot of our users use our platform to share pictures as well as articles. But I had told the story so much to investors that what's different about us is that we allow consumers to share articles, not pictures. And that's why we're different. We're about thoughtful content. When in reality, the market pull wasn't for that haughty content. It was for the lesser interesting content. And I think the failure there is, to be very honest, I believe my own story.
Yeah.
And, it's back to, we all tell stories. As VCs, we tell stories to LPs. As entrepreneurs, we tell stories to VCs. Back to the question, it's very important to not, don't tell a story just because it's a good story, and then don't believe the story too much. Now, fortunately, Snippet actually ended up, Marissa became CEO of Yahoo, and she reached out to us because she wanted to make Yahoo more social, and we were a very strategic acquisition for them. So they acquired the company. But in retrospect, had we just did that small pivot towards pictures, we could have created a lot more value.
Wow. Unreal. Great lesson there. On today's special segment, we have Mark Suster of Upfront. Mark, can you tell us a story about a portfolio company that failed and why it failed?
Oh, God. I hate to do it in a way because I hate to pick on anybody. Well, I'll tell you a company that did not turn out to be as successful. I'll give you a couple real stories, okay? So I backed a company called DataSift. And what DataSift did is they took data from Twitter and they created tools to allow third parties to be able to extract and use that data. It was a brilliant product. Twitter themselves couldn't do it at the level that we could do it. There were 2 or 3 competitors in the market. We had something known as platform risk, which is we had one major data source. And no matter how much we tried to get other data sources, and we did get other data sources, none were as in demand as Twitter was. And then Twitter turned around and bought our competitor. And once they bought our competitor, it made life a lot harder. So what did we do? We then landed Facebook. And, we got the bigger prize. And then Facebook used us for a few years, and then they canceled the project. So what did we do? We got LinkedIn. And LinkedIn, in a way, needed us more than anybody else because they were trying to increase the value of their inventory and be able to show people how valuable that is. And the best way to do that is with data. But having been through 3 cycles of platform risk, eventually it just became unfundable. People who believed in the story and were willing to write checks in the past weren't willing to write it. And my lesson learned, and I said this at the time, and it's convenient for me as a VC to say this, but I said all along, we need to diversify our product. We are taking orders. We are order takers because of Twitter, not order takers necessarily because of our product, even though our product was great. And that's dangerous. Number 2, I felt the platform risk when Twitter canceled, and I feel like we should have just massively slashed our sales and marketing and preserved our cash. But, we were growing so fast, and it's so hard to readjust. Once you have a staff, it's really hard to slash and go back to where you were before. And, sometimes when outlook changes, if you're super aggressive and make the hard decisions early, you survive. And when you don't, you don't. We have another company that was in the hardware space. And actually, there's 2 separate companies, so I probably won't name either, but they both made the exact same mistake, which is they produced a hardware product that we both thought the market wanted that had a replenishment product. So we're not just a consumer electronics company.
Yep.
In both cases, the founders built their dream product. Let me just call it the Rolls-Royce version, okay?
Oh, yeah.
Just to have, and they packaged every possible feature into the product. And then they got feedback from the market, both through a crowdfunding campaign that did incredibly well. But then you realize those are like the early adopters who are willing to pay any price, or from the channel partners who were saying, yes, you can price this product at $1,200. And if you only have a Rolls-Royce product, you'll learn a term from economics that's called price elasticity. Price elasticity says, if you drop price, does demand go up massively? And if you drop price and demand goes up massively, or if you increase price and demand goes down, you have what's known as an elastic product. If you can double your price and demand doesn't drop, you have what's known as an inelastic product. Like the best examples of inelastic products are cigarettes and alcohol, right? Like double price, people still are going to smoke and drink. Mm-hmm. But most consumer electronics, are fairly elastic. And so, I was advocating for a lower quality product. Lower quality doesn't mean bad quality, lower quality product at a lower price point because I don't believe in super high price points for most products.
Yeah, less features. And we talked about disruptive stuff last time you were on the show.
Yeah, and honestly, both of them were overspec'd. And both of them did really well with initial sales campaigns, and then both of them hit a brick wall. And when they did, they're like, okay, we're going to design the next version that's much cheaper. And to do it, it's like a couple $1 million of what's called NRE, non-recurring expense. It's like you have to do all the, the manufacturing equipment and the setup and the design and stuff. And, if you take a product that's $800 and you say, I need $2 million to produce a version that's $375, and you've blown through $8 to $12 million of venture capital to get there, people generally don't want to take a second bet and see if the low-cost product has legs. And I think both companies, they built really, really, really good products. And I think both companies were totally spot on that there was demand for their category. And I think price matters, and understanding economics and elasticity matters. And I think if you nail your product at a price point, you can always sell attachments, you can always sell accessories, and then you can always create the premium version after the fact, and then help migrate customers to a better version of the product, but they overspec it.
That will conclude this installment of Investor Stories. If you're enjoying the program and would like to see it continue, take a moment and leave a 5-star review in iTunes. Also, if you'd like updates on new content from TFR, as well as the top 10 VC articles every week, go to fullratchet.net and sign up for the newsletter. Okay, that will wrap things up for today. Until next time, over-prepare, choose carefully, and invest confidently. Thanks for joining me.